Greetings to everyone. My name is Edward, and you can call me Ed for short. Here is pros and cons accountancy tutorials, and you're all welcome. Today, our focus is on income taxes, which is IAS 12. So let me say what we are going to do is to deal with some aspect of IAS 12. Then in our next video, we also focus on some part of IAS 12. Now, if we say income tax, what do we actually mean by income tax? So income tax can be said to be an amount levied on an individual income or a company's or entity's profit. So surely income tax is it's an amount which is levied on an income that an individual earn or profit that the companies or entities earn. In this section, we are actually going to talk about two things because income taxes in terms of IAS 12 talks about two things, which is one, your current tax, and then the deferred tax. So as I said, what we are going to talk about, we have the two things, which is the current tax, your current taxes, and your deferred taxes. Now, one, what do we mean by current tax? What do we actually mean by current tax? So when we talk about current tax can simply be termed as the taxes that we are paying to the taxes you are currently paying on the profit that you have achieved or the income that you have achieved currently. So in current tax is the current tax you pay, the taxes you pay on your current income or your current profit. Then how are we going to calculate for it? If you have an entity and you get a profit, let's say you get a profit of 10,000 and the tax rate in your jurisdiction is 25%, then your current tax is just going to be the 25% on the income that you've earned or the profits you've earned. That is basically our current taxes. Surely current taxes, we need to do some calculation, we need to do some adjustments here and there in terms of if we want to deal with it in our financial statement, the P&L. So it is something that we are going to talk about in a later date. So the IAS 12, even though it talks about current taxes and then deferred taxes, the focus is much on what the deferred taxes. So our focus today is to learn how to deal with what the deferred taxes. Then subsequent videos or our next video, we will talk about how to account for both the current tax and then the deferred tax in our financial statements. So without much ado, let's go on and understand what we also mean by a deferred tax. So in simple terms and on IAS 12, a deferred tax is more or less a notional amount that is also levied, but this notional amount is actually calculated on what we call a temporary difference. So deferred taxes are taxes that is levied on a temporary difference. Don't get it twisted. We will get to know the things that we need to know when we talk about our deferred tax. So one aspect of it is the temporary difference. One aspect of it is the temporary difference. So let's continue. Now, what then do we mean by a temporary difference? When we say a temporary difference is just the difference between your carrying amount and the tax base. So you can see that I've mentioned two things again. First, I mentioned of a temporary difference. I've also mentioned under the temporary difference, I've mentioned your carrying amount, and I've also mentioned your tax base. So let's go into these three things. One, I mentioned temporary difference. Two, I mentioned your carrying amount. So one will call it carrying amount or net book value. Three, I made mention of your tax base. So when we talk about your carrying amount simply means the amount at which you are keeping your asset in your book. The amount at which you are keeping your asset or liability in your financial statement. It's what we call carrying amount. So in simple terms, our carrying amount may be the cost of our asset or the cost of our asset less depreciation. The cost of our asset less what? Depreciation. Then what about tax base? So when we talk about tax base is the amount that the tax authorities expect us to keep the assets in our book. So we may be keeping the net book value in your books as 10,000, but the tax authorities expect the tax base to be equal to 8,000. So in that case, the difference of 2,000 is what we call temporary difference. It's what we call temporary difference. So when we talk about the temporary difference, the carrying amount, and the tax base, this is the simplest way of what talking about. Now, what do we mean when we say carrying amount? What at all is the difference between carrying amount and tax base, aside using these figures? You know, for the assets, you, the accountant, calculates for depreciation. But the tax authority in Ghana, the revenue authority, we call them Ghana Revenue Authority. In our local jurisdiction, we call them Ghana Revenue Authority. So the Ghana Revenue Authority will be expecting capital allowance instead of what? Depreciation. So you, the accountant, calculating for depreciation and the tax authority calculating for capital allowance, there's surely going to be somewhat differences, because if the rate at which you guys are using the asset is not the same, the rate at which the accountant and the tax authorities are using the asset is are calculating depreciation and then capital allowance is not the same, then surely there's going to be a difference between the net book value and the tax base. And that is what gives us what? The temporary difference. So let me go back again. Carrying amount is actually calculated based on principles, accounting principles. However, the tax base is calculated based on what? Tax laws, the juridical tax law, the jurisdiction that we are in, the tax laws. That's what we use for calculating what? The tax base. Again, whilst the accountant is calculating depreciation, the tax authorities or the Ghana Revenue Authority will be calculating what? Capital allowance. So mostly companies, what they do is to make sure that their depreciation rate is equal to what? The capital allowance rate. So that in that case, you don't come and then get differences between the tax base and the carrying amount in order to even lead to deferred taxes. Because without differences in this, there will be nothing called what? Deferred taxes. Now, how do we then calculate for carrying amount? So carrying amount is just your cost less depreciation. Then what about tax base? Tax base is your cost less what? Capital allowance. So now that we've been able to calculate for our carrying amount, we've been able to calculate for our tax base, or let's say we understand carrying amount, we understand tax base, and we understand temporary difference. What IAS 12 taxes talks about is that now that we have a temporary difference, let us charge tax on this temporary difference. The tax rate within our jurisdiction, let us charge on this temporary difference. Then we come and get what we call deferred tax. So in simple terms, the difference between your net book value and your tax base, we calculate our tax rate on it. Then we get what we call deferred tax. But this temporary difference is in two folds. We can get a taxable temporary difference or a deductible temporary difference. So again, the temporary difference, we can get a taxable temporary difference and a deductible temporary difference. So this, we are saying that we can have deductible temporary difference and taxable temporary difference, deductible temporary difference or taxable temporary difference. So let's explain. How do we get deductible temporary difference? And how then do we also get taxable temporary difference? We can only get deductible temporary difference if our tax base is higher than what? The net book value. So if we look at this scenario, we can easily see that this is not a deductible temporary difference. This is not leading us to a deductible temporary difference because our net book value was rather what? Higher than the tax base. And once our net book value is higher than what the tax base, then we get what we call taxable temporary difference. Again, taxable temporary difference. But if our tax base was rather higher than the net book value, then we are getting what we call what deductible temporary difference. Now, if your net book value is higher than the tax base, then it simply means that you are keeping a certain asset. You are keeping a certain difference in your book. And the difference, the Ghana Revenue Authority is saying that we have to charge you tax on it. But as we said, this is the difference is a temporal. It's temporal because it is something we are not okay with. The tax authorities is bringing it. We are also they are bringing their own figures. We are also bringing our own figures. So it is temporal in the sense that there can be a situation whereby we can recover the amount that they're talking about. We can easily there can be a situation whereby we can recover the taxes that they are trying to charge. So first, let us understand temporary difference. Let's understand carrying amount as we know. Let's also understand tax base, and then also know that for the temporary difference, we have what we call deductible temporary difference and a taxable temporary difference. Now, after we've gotten our temporary difference, I first mentioned that we have to calculate our tax rate on it, or we have to charge our tax rate on it in order to get what the deferred taxes. So we can charge our tax rate on either a deductible temporary difference or charge it on what a taxable temporary difference. Now, if we charge our tax rate on deductible temporary difference, we get what we call deferred tax asset. So deductible temporary difference is leading us to what? Deferred. It's leading us to deferred tax asset. It's leading us to deferred tax assets. Don't worry, we are going to explain what we mean by deferred tax asset. Deferred tax assets. However, if we charge our tax rate on taxable temporary difference, then we get what we call deferred tax liability. Deferred tax liability, pardon me. Deferred tax liability. So that is what we mean by so this whole thing, or very, very simple. This is very, 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 very simple. That's what we mean by what calculating for your deferred taxes. Now we've gotten a deferred tax asset and a deferred tax liability. So let's break it down. What do we mean by deferred tax asset, and what do we mean by even deferred tax liability? If something is an asset in your financial statement or in your trial balance, if something is an asset, then it means that it belongs to you. Is that not it? It simply means that it's something which belongs to you. So by getting a deferred tax asset, it simply means that we have to add it to our assets. We have to add it to our assets. Then what about a deferred tax liability? A liability is something that we need to pay. So if we need to pay, then it is a liability for us. So we have to recognize that was as a liability in our financial position. You have to recognize as a liability in our financial position. So this is the simplest explanation that we want to give to you on income taxes, talking about current taxes and then deferred taxes. Now, let's give a brief of all what we've done so far in terms of dealing with deferred taxes. So in terms of dealing with deferred taxes, we are saying that one, you have to determine the carrying amount. Two, you determine the tax base. And then three, you find difference. So So find the difference or your temporary difference, right? Determine the temporary difference. Determine the temporary difference. And what is the temporary difference? As we said, is the difference between what? Your carrying amount and tax base. All right. So you have to analyze the temporary difference. You analyze the temporary what? Difference. And in analyzing this temporary difference, it can be a temporary, a deductible temporary difference or a taxable temporary what? Difference. So deductible or taxable. So you can have a deductible temporary difference or a taxable temporary difference. Then 5, you now have to apply your tax rate on the deductible temporary difference, on the temporary difference. And we are saying that in this case, you are going to get your what? You are going to get your deferred taxes. And it may be an asset or a liability. So this is all about deferred taxes. This is all about the deferred taxes. With this simple explanation, let's try and then solve some scenario and see how best we can deal with that, right? So let's take this as an example. Let's take this scenario as an example. So illustration 1. Ed Limited has the following assets and liabilities recorded in its financial statement at year-end December 2024. We have the assets and liabilities, we have the carrying amount, and then we have the tax base. So what do we need to do? All what we need to do is to find the difference between the carrying amount and the tax base. Here, we were lucky to the sense that it means depreciation and capital allowance has been calculated for us. So all what we need to do is to do what? Is to find the difference between the carrying amount and the tax base to get our temporary difference. So let's go to our board and deal with that. We have PPE, inventory, trade receivable, trade payables, and then cash. So without much ado, let us go to our board and deal with that. So our illustration 1, we have the asset PPE. Let me get the question so that we can deal with it as fast as possible. So we have PPE, we have inventory, we have trade receivables, and then we also have trade payable. And then lastly, we have cash. So we have our carrying amount, which is the same as our net book value. And then we have the tax base. So the carrying amounts, we are having 40,000 and then a tax base of 25,000. Here we have current amount of 10,000 with a tax base of 14,000, 6,000 with a tax base of 8,000, and then also 16,000 with a tax base of also 16,000. And then here we have 5,000, another 5,000. So what is our temporary difference? What then will be our temporary difference? So our temporary difference, if you look at our PPE, the tax base is higher, is lower than the carrying amount. Simply means we are getting what we call a taxable temporary difference, as we earlier explained. So a taxable temporary difference of 15,000. When we come to our inventory, we can see that the tax base is higher than what the carrying amount. So we are having what a deductible temporary difference. So we can take it out from the taxable temporary difference. So a deductible temporary difference of 4,000. Then trade receivables, we can see that our tax base is again higher than our carrying amount by 2,000. And trade payable, we have no difference. Cash too, we have no difference. So the question we ask ourselves is, what then will be the total that we need to charge? So the total, are we getting a taxable temporary difference or deductible? We have 15,000 less 4,000 less 2,000. So it gives us 9,000, which is a taxable temporary difference. Which is a taxable temporary difference. Now, the question gave us our tax rates, our reduction, the tax rate. The question gave it to us to be 25%. So in that case, then our deferred tax will be equal to 0.25 times 9,000. And that will give us 2,250. So this is our deferred tax based on this scenario. This is our deferred tax based on this scenario. First, we were supposed to calculate our temporary difference for which we've done. And then we are also supposed to calculate for the deferred tax for which we've done. So this is a simple illustration on IAS 12, income taxation, focusing on deferred taxation. So what I will do is we will end it here. Then our subsequent videos, we will talk about how to account for both the current taxes and the deferred taxes in our financial statement. Until then, I say goodbye.